Today, we're excited to bring you an exclusive interview with one of the top mortgage advisors in Canada, touching on anything from first-time homebuyers to insights, as well as his outlook on the mortgage market heading into 2026. Welcome back to the channel. My name is Norton Ngo. I'm a real estate agent here in the city of Ottawa. If you find this video valuable or learn anything new, all I ask is you hit that thumbs up button and subscribe to the channel. If you have any questions directly on the market, you can book a call directly with me through the first link in the description. Let's get into it. So Chris, thanks for coming on. Obviously, second time around. Last year, we obviously had that interview to get a little bit more about your team and also more first-time homebuyer related questions. But this time around, want to bring you on almost the same time of year for kind of your outlook as well as what you're seeing on the market. So to kick it off, maybe tell us a little bit about your team.
Yeah, for sure. We're 16 years in the business now. I can't even believe I'm saying that. We are a team of 9 or 10. We've got account managers, underwriters, document fulfillment people, and we do mortgages for first-time home buyers, people upsizing, downsizing. We do reverse mortgages, construction mortgages, a bit of it all.
Awesome. Perfect. And obviously you guys are our go-to team, so it's good to have somebody work very closely with on the mortgage side, and we're confident in services as well. So maybe to get into it, how would you kind of describe 2025 from the mortgage side, what you're seeing day to day, and then we'll kind of get into a bit of a chat about what we saw on our side as well.
Yeah. So in 2025, I mean, we definitely saw an environment where we had a lot of clients calling us wanting to qualify. Qualification definitely has been a challenge over the last few years, with rates being where they are and the government measures to make it harder to qualify.
Right.
However, mortgage interest rates had been improving from a borrower standpoint, meaning rates had been improving, going down. And so people's borrowing power was a little bit better as 2025 went on. So when I look at our numbers, like October, November, December, we did a ton of transactions on the back end of the year. And I think it's primarily because qualification was a little bit easier.
Right. We saw a bit of that as well. Like, and I would say, and we'll elaborate on this a little bit as well, but I would say it was a very, in some cases, first-time home were a big segment of the transactions. Would you guys kind of have that similar sentiment?
Oh, absolutely. I mean, we help a ton of first-time home buyers, as you do. And I find with the first-time home buyers, they kind of reach out to us earlier in the year in many cases, right. and we do a bit of planning to make sure that they can buy at one point throughout the year. So right. We had many borrowers that we kind of touched base with over a 3-month period, but sometimes it's a 12-month period just to make sure we get them set up and qualified.
Right. And I think that's actually a really valuable point of view, is that oftentimes we'll have people, maybe we have a seminar coming up in February, that people might initiate the process and it actually might be a late spring or even summer, for example, purchase, right? Where they're building a plan. And I think that good teams and good professionals will set out that plan if it doesn't matter if you're not buying this year, right? That's totally okay.
Of course. And you know what? A lot of borrowers will start off the call, especially first-time home buyers, and almost apologize that they have questions. And we always remind borrowers, like, we are here to answer all of the questions you have, and it's our pleasure to do it.
Right. Perfect. And that kind of, like, I would say that leads into our next question of, frankly, I see this from the front lines every day, and I have a few close friends that actually ask this question. So I feel like it'd be valuable to add this in the interview, is that affordability. Like, for first-time home buyers, I've had a few friends that ask me, like, Norton, who's buying these homes? Like, they're expensive, right? You have maybe somebody that's just by himself, or maybe a group of siblings that are looking into buying together. From your point of view, like on the other side of the equation, being financing, what would you say is kind of the profile of your prototypical 600K to 700K purchase? What would you say is kind of the makeup of that dynamic, like from what you've seen?
Yeah, I mean, certainly there's a ton of first-time home buyers in that bracket.
Right.
With that in mind, though, typically if they're buying for $600,000 or $700,000, that household income might be something like $150,000 a year, right. with no debt,
right.
Limited down payment perhaps.
Right.
Or maybe the household income is a little bit higher, like $200,000, but they've got a car payment and a bit of a student loan or something like that.
Right.
So it definitely requires quite a bit of income. We also have a lot of first-time home buyers who have co-signers. Like, it is the norm now. Right. I would say it's more normal than not.
Right.
So in many cases, these applications might have husband and wife, young professionals, and then mom or dad co-signing, or grandma, grandpa co-signing.
Right.
And these are typically people who are, like, the co-signers are either also higher income earners with a small mortgage, or if it's, let's say grandpa, grandma, they typically don't have a mortgage left, and they might be pension income earners, but that additional income makes a difference for the first-time home buyer.
Right, so they're adding to the file.
That's right.
Gotcha. Yeah, I mean, it's challenging, right? Like you have people that are maybe eligible to get into the condo asset class, but for their plan, it's freehold. Like that plan is freehold, and maybe they want a backyard. So that puts you really quickly into that 6 bracket, right? So
For sure. I would also say on that, for the first-time home buyers that don't necessarily qualify for a purchase price of six or $700,000, we do see that group of buyers end up buying a stacked condo or a smaller, less expensive condo, maybe slightly outside the city. I mean, we see all sorts of stuff, of course, but we're often seeing that if they can't quite get to the freehold townhouse, they're still happy to buy a stacked condo.
right. And I think it gets tricky though, right? Where you have people that are in that, call it same price bracket, but maybe they're buying that bungalow, but it also needs another 100 after that, right? So that's where it gets tricky. Like we've seen that a lot in our book, where they're dipping in both pools, if you will, like the freehold freehold town, and also made the bungalow in a mature neighborhood, but it's tricky with the renos, right? And I'm sure you see that as well, right?
For sure. Yeah. I mean, it's different price points. And then we dive into conversation around, well, how much money should we use as a down payment? Should we keep some money off to the side for a potential down payment?
Right.
Should we use a specialty program like a purchase plus improvement program? So there's definitely a few angles there. And I'd say that be mindful that the more work there is to do on the home, you probably should consider that it's worth having a bit of extra money in the bank account as a safety net.
And how does that, I've heard about it, and we've crossed it indirectly with some clients as well, but how does that purchase plus specifically work from the mortgage side?
Absolutely, good question. So the standard purchase plus improvement program is when a borrower purchases a property and they would get professional quotes for the work to be done. So let's say they want to redo a bathroom or flooring or kitchen. They would provide a professional, like general contractor quote for these items to be repaired or redone.
Right.
And what we'll do is we're going to take the original purchase price and the renovation quotes, add them together, and determine a new kind of like fake new purchase price.
Okay.
And so ultimately what that does is we determine a new future value. And so long as the property appraises for this future value, assuming the renovations are done, then a borrower may qualify. Now, just to elaborate on how the purchase plus like logistically works, you essentially get approved for the mortgage and the additional funds, but those additional funds end up sitting at the lawyer's office. The borrower has to do the renovations themselves, whether that be on their line of credit or a credit card, or if it's a general contractor, they're going to do the work and you don't have to pay for the bill up front. You pay once the work is done. And so once the renovation is actually completed, the lender will send an appraiser to visit the property and make sure that the work outlined in the quote was actually completed.
Reflective,
Yeah, so it's got to, if you said it's, hardwood flooring, you can't have changed the material type. Like it has to be in the same quality bracket.
Right.
And so assuming all the work was completed properly as per the quotes, then the lawyer will release the funds to the borrower so that they can replenish, their line of credit or credit card, or pay that general contractor that they owe money to.
Right.
I will say that historically the programs were made for $40,000 of renovations. However, many, or I'll even say most lenders now, allow us to include up to 100,000 of renovations within these purchase plus programs. I would say if the renovation program is, or if the renovation is more than 100,000, at that point it really starts to be an exception territory, and I would say that you shouldn't assume that is doable.
Or the most viable object. Right?
Yeah.
Really. Okay, gotcha. No, I've had a few clients ask us that, so that's good to talk on that.
I want to touch on an additional point here is if the renovation is more than $100,000, at that point, in many cases, it's like a full like gut and redo or things like that. That's much more of a construction type project rather than a purchase plus. And let's remember that a purchase plus program is made for home improvements, not a whole gut rehab.
Wholesale renovation.
That's right.
Yeah, perfect. Okay. And again, this touches on first-time homebuyers as well, but we specialize in helping many first-time homebuyers in the market. What would you say are maybe I would say education is not the missing piece, right? Like we're there to be resources as well, but there's so many resources out there that first-time homebuyers do tap into. with that said, what would you say are some of the maybe mistakes that you see, or common kind of maybe decisions that were made that maybe you've seen that maybe were not the best interest of the buyers out there?
Yeah. I mean, it's tough to label them as mistakes because kind of like life happens, you have to do certain things. I would say that a few items that hinder mortgage applications that are consistent or reoccurring challenges are car loan payment obligations. So if a borrower is hoping to qualify for a mortgage loan, if you don't have a car payment now, I would encourage you to wait and to get that new car until after you've purchased a home.
So you can't finance an Audi right after.
Probably, yeah, you can definitely do it after you take possession. And the reason this matters is because if you've got let's say a $500 a month car payment, that might reduce your borrowing power by about $100,000. If you've got a $1,000 car payment, now you're talking maybe $200,000 of less in mortgage qualification. So you can see how it quickly limits your borrowing power. And that's just one of the many challenges that we see. There, others that I can think of kind of off the top of my head here would be someone who, let's say you've got an electrician who might be 3-4 years in the business. He's been kind of working for a company, and then he or she may choose to become self-employed. The file quickly becomes much more challenging as a self-employed file.
Right.
Typically, a lender will want that borrower to be self-employed for 2 years before qualifying for a mortgage. So
drastically changes their profile.
Absolutely. So change of employment is something that you want to chat with your mortgage broker before making a change. And in saying that, I gave you the example of the electrician changing from employed to self-employed. There are exceptions to that 2-year rule. For example, in many cases, if you're staying in the same line of work, you might be able to get away with 1 year of self-employment.
Right.
So there's always ways to get files approved. But if you want to make any sort of change, definitely speak with your mortgage broker before doing so.
It's best to at least have all the cards on the table.
Absolutely.
Good. Over the last couple of years, definitely rates have been a big conversation. We'll chime in on it a little bit as well after. But what are the kind of conversations you're having on the fixed versus variable dynamic? Maybe some of the, I would say, boots on the ground stories that you're seeing. What are you kind of seeing on that dynamic?
Yeah, I mean, when it comes to the fixed and variable dialogue, in many ways, it can be a half-hour discussion. Like, there's so many things to unpack. I would say that a few of the important pieces when someone's comparing fixed or variable is to understand that there's not one universal product that is better. You have to make an educated decision based on your interests and your priorities. So, the question I often get is, should I go fixed or variable? Which one will outperform the other? Like, I don't know. The mortgage market is complicated. The global economy is increasingly difficult to predict. I would say that we try to focus more on the product nuances rather than which one will actually outperform the market, because we cannot predict it.
Right.
So what I mean by that is, let's use a variable rate mortgage. Well, most variable rate mortgage products will have a payment that fluctuates.
Right.
So are you someone who's going to be losing sleep over your payment fluctuation? If you are, you're probably not well suited for a variable rate product. Another thing to be mindful of in the variable rate space specifically is, if you think you might break this mortgage contract, a variable rate product might be well suited for you, because a variable rate mortgage product will have the smallest mortgage penalty to break the contract. So that's more on the plus side. For the people that are kind of on the fence of going variable, I like to remind them that you can switch from variable to fixed during your contract without penalty. It just requires that you kind of pay attention. If rates do start to rise, you kind of have to jump ship early and make the change if you feel like you've got a concern with the raising rate environment.
Right.
But if we talk to people that might be in our parents' age group, they like to remind us that when they were getting their first mortgages, rates were 18% and things like that. I don't believe that we're going to be seeing those types of rates ever again, really. Right. We're talking right now, mortgage rates are somewhere between the mid 3s and 4.5 maybe. Yeah. So the norm in payment fluctuation is still manageable for most.
Right. So mitigating risk on the more, it depends on their personal situation.
Yeah, for sure. In all that said, though, we are in the city of Ottawa, And so a lot of our clients have full-time salaried jobs. They know what their budget is, and many of those borrowers may elect to go with a fixed rate just to choose to set it and forget it. And they have a monthly budget, and they want their mortgage payments to be reflected in that spreadsheet for the next 5 years.
Right. Peace of mind. Peace of mind. That kind of chimes into the next question regarding down payment, right? So we have clients that ask us, and in many cases we provide some insight, but divert them towards a professional as well. In terms of the 20%, not 20% dynamic, obviously you're paying that mortgage insurance premium, but what's your view on that, and kind of perhaps some of the dialogue you're having with buyers that are on the fence on that?
I don't think there's a serious need to do 20% down. Like, by all means, the most cost-effective scenario is to come up with 20% of the purchase price as a down payment. But if you want to think about that scenario further, like, the best mortgage is not having one at all. So are you just going to continue saving until you can buy a house in cash? Like, where is that sweet spot? So yes, if you have the means to come up with 20% down, power to you. You should use that 20% down.
Right.
If you buy with less than 20% down, you will have a mortgage default insurance added to your mortgage. So there's a cost associated to buying with less than 20% down. But there are a few perks that maybe aren't talked about. You will have access to a marginally better interest rate most often. And I say that because for insured mortgages, lenders typically price those with a better interest rate.
Right.
When you do the math over time, it is still mathematically better to have 20% down. But I tell everybody, like, do not beat yourself up on not having 20% down. Most first-time home buyers do not. In fact, even second-time home buyers often don't have the 20% down.
20, the full
Yeah.
20 down.
So it's not something to worry about at all.
For sure, because that conversation happens all the time, right? They're having, like you said, buyers in today's marketplace are so well educated they've had pieces of the equation. Maybe they had a sibling that went through the process, right? So they're constantly asking these, questions about 20 versus not 20, right? So
yeah, and then you kind of dive into the whole dialogue of, like, is it better to get into the market now or later? Like, if you can get in with 10% down, is it better than waiting and getting to 20% down? Again, like, we can't predict the future.
Dynamics, 100%. We hear 2026, as we head into this year, we're now in February of the year. We hear 2026 is the year of the most mortgages that are coming up for renewal. You have your COVID mortgages that maybe took a 5-year fix, for example, and as rates elevated in 2023, maybe they took a 3-year, bridge mortgage through you guys or other professionals. What do you see on that front? What are you advising on people that are perhaps maturing in 2026?
Yeah, I mean, the first thing that we ask our clients, whether it's a new incoming client or an existing customer, we will typically tell them to reach out to the existing lender and find out what the renewal rates actually look like. Sometimes the existing lender is going to be very competitive on price, and sometimes they're not going to be. So if the existing lender is going to be very competitive on price, then we have the borrower just renew directly with the existing lender. But there's many clients who the existing lender is not going to be the most favorable. At that point, we want to compare the existing lender's rates to the rest of the market. If there's a way to save a borrower some money, great. But beyond just the rate, there are borrowers who do feel a little bit tight with cash flow, and rates of today are higher than rates from 5 years ago.
For sure.
Even compared to rates from 3 years ago, perhaps. And so the idea that rates are up and payments are going to be up don't have to be that scary. What I mean by that is that in many cases, we can re-amortize the loan. So let's say you've got 20 years left on your mortgage or 25 years left on your mortgage. We can move that mortgage back out to be over 30 years. And in many cases, that will give you payment relief. It makes your payments go down.
Right.
And in turn, maybe you can match what your original payment was on the last mortgage.
Right.
Again, there's pros and cons to that.
Of course.
But we absolutely want to have a cash flow discussion to see, are today's rates negatively impacting your current cash flow?
Sure.
But at the same time, let's be mindful that a lot of these borrowers now earn a bit more too, and maybe they're okay with these payment increases. So there's a lot that goes into the dialogue of renewal. And I'd also add that it's also a great time to reassess whether you are still happy in this existing home. Do you want to sell and buy something different now or in the near future?
Right.
Should we refinance, convert this property to a rental, and buy another property and work towards building wealth through real estate? there's so many angles that we focus on at renewal. It's not only the rate itself,
Right.
and I'd say the thing that we manage a lot as brokers is that historically lenders used to reach out to clients 4 to 6 months in advance and offer renewals at that time.
Right.
Seemingly, lenders have realized that the best retention tool is to not reach out to the customer at all. That's right, or leave it to the last minute. So it's not currently out of the ordinary for the existing lender to reach out 30 days in advance
And squeeze like that.
and
right.
try to squeeze you to just sign.
Right.
And so in saying that, we do recommend that our clients reach out to the existing lender at the 120-day mark or the 90-day mark prior to renewal.
Proactive conversations, right?
Absolutely. The more info you have, the earlier you have it, the better the renewal experience will be.
For sure. Okay, that's good to know. And that kind of you chimed on it a little bit as well in terms of the dynamic between maybe they're up for renewal, they're exploring, perhaps like you said, turning it into maybe a rental property or not. They don't need to sell it to move on to the next property. How does that process work on your front, on the mortgage side, and perhaps qualifying and making sure the numbers all penciled to be able to convert it into perhaps a rental property? How does that process work?
Yeah, I mean, really what we're doing is working towards a pre-approval of a purchase on the assumption that you still have an existing mortgage. With that existing mortgage, we offset some of that cost based on what we think the fair market rent will be. So that's when we tap into our realtor friends and say, hey, how much do you think this property would rent for? And we'll use that number as a placeholder. And, if it's a break-even scenario or slightly cash flowing scenario, we might be in a scenario where you can keep it as a rental and buy something else. The application process is the same whether you were doing a pre-approval without an existing home or not. It's a matter of providing income confirmation, ID, and assessing what the qualification really looks like. I would say that to many people's surprise, they often do qualify to keep the existing property as a rental. But where we do run into issues or challenges is that do they have the down payment required to buy something else?
Yeah.
I'll bust a myth right now. You can buy that second property with 5% down or the minimum down payment. Oftentimes people think that you have to have 20% down. That is not correct. So you can buy another owner-occupied home with as little as 5% down. And so often clients are able to put a few pennies together and get to that minimum down payment requirement.
For sure. Okay, that's good to know. And you touched on it a little bit as well, but that upsizer segment of the market, right? We see it in clients that we have. Maybe they own properties before. We had an opportunity to work with them, or maybe, their current dynamic just doesn't really fit the family need, for example, right? But maybe there's not as much equity in the property. How are your conversations you're having right now with people that are exploring upsizing? There's not much equity in the property, or maybe they have no equity in the property. How are your conversations like that right now in terms of we hear it in Toronto, we hear it in Ottawa as well, and across Canada really, but how are these conversations on upsizing, but they're planning kind of the moving pieces?
Yeah, I mean, look, the reality is if there is no equity in your existing home because the value's gone down a little bit, at that point, you can't really sell and buy because you don't have a down payment. So the question becomes, well, do you have money saved for a down payment? Are mom and dad gifting you a down payment? Like the conversation quickly goes there if you have no equity in your existing home. If you have a little bit of equity or some equity, well, hopefully it's enough to have the minimum down payment requirement to buy that future home. So look, it doesn't have to be a good or bad conversation. It's just a fact-based dialogue to see how much existing equity is in that property.
I would say our next question in terms of the investment side, right? The allure of investments, right? In terms of looking into the market, I would say has altered or shifted in some dynamic in terms of prices are a lot more expensive than previously. Whether it's people putting their money in other investments, that's another thing that we're seeing as well. But what would you say are your thoughts, and maybe what, if you're an active participant in today's market, how would you kind of evaluate or look at the market as a whole in terms of looking into investment real estate as well?
I mean, every market's different, right? So it's almost impossible to make a blanket statement Canada-wide. I think if we focus, if we focus on Ottawa and the general surrounding area, typically you will find more cash flowing properties to be slightly outside of the Ottawa area, right? Smaller market properties might cash flow a little bit better. And so I find that those definitely have some intrigue because the borrower can not only cash flow and help their bottom line, but it's also easier to qualify for it.
Right.
I'd say the reality is for much of the investment real estate in Ottawa, These days, it's about breaking even.
Right.
If you break even or make a very small margin, a lot of these properties are purchased for the idea that it will be worth more in the future, and you've got someone else paying down your debt.
Right.
In many ways, gone are the days where every rental property cash flows.
Cash flow is positive. Oh yeah, for sure.
That's just not really a thing, right? So, yeah, I'd say investors these days are looking for properties that have small cash flow or break-even positions, but I find oftentimes they're value adds. So it might be buying a duplex and adding an additional unit to make it a 3-unit, perhaps,
Right. Yeah.
right? And sometimes those metrics make the numbers better. I mean, I know that on my end, I used to have I still have a side-by-side duplex, and I added a 3rd unit, and
Right.
that's what allowed me to cash flow better in that property. So
Right. And
it is something that we see quite a bit.
opportunities to be had, for sure.
Yeah,
Okay.
for sure. Plus, there's the idea now where a lot of the Ottawa area, you can build, let's say, an 8-unit,
It
perhaps.
just passed the new zoning bylaws, right?
Yeah. So I'm getting a lot of questions around, like, how does qualification work? And I'd say that maybe the one thing that a lot of borrowers need to be aware of is if you go and look to qualify for a property that's more than 4 units, with most lenders, that means you're in the multi-residential or commercial financing space.
Financing space, right?
That's right. And so it's no longer the standard qualification rules. A lot or most of the weight is based on the numbers of the asset or the real estate,
The deal itself.
the deal itself.
Right.
And I would typically tell people that you basically need to have the property cash flow by about 20% in order to get approved for a mortgage. I'm super generalizing,
Of course,
but if your monthly carrying cost, including insurance, property taxes, utilities, property management, are $10,000 a month,
Right.
well, that property needs to generate about $12,000 of rent
Monthly rent.
to actually qualify for the loan that you need.
For sure. No, that's good to know because we, of course, like that actually just passed last week. So in terms of the new zoning bylaws and what people are looking into opportunity-wise, perhaps, I'm sure you're getting lots of calls on that. So
I can tell you, like, the amount of messages I got from Google Places, people finding me online and seeing that I do multi-res financing, like it skyrocketed quickly in the week right after the announcement.
in that week. Okay, good to know. I know you're quite active in terms of going to these industry events and conferences across top institutions as well. What is kind of the outlook that you see in terms of course, we don't have that crystal ball, if you will, but from what you're hearing on the front lines on mortgage rates and more so in terms of that dynamic, what's the kind of outlook that perhaps some of the institutions have that you've come across?
Yeah, I was recently on a video call with an executive vice president of Canada's biggest mortgage company.
Yeah.
And one of the things that they pointed to was that they used four of the big banks as examples, and they were like, 2 of the banks expect a Bank of Canada rate drop of 0.25% in the near future. One bank thinks it'll remain stable, and one bank thinks there's going to be a 0.25% increase. So there's 2 things that you want to remember out of that thing comment is that no one really knows,
Right.
and 2, that generally tells us that they expect it to remain relatively stable because an increase of 0.25% or a decrease of 0.25% in the mortgage world is pretty common. That happens sometimes even on a monthly basis without making the media headlines.
Right.
So the expectation is that rates should remain somewhere around where they are today. So today's rates are plus or minus 4%,
Right.
let's say 3.5 to 4.5.
Yeah.
And that's really the expectation for the year. Like, rates should remain within that category. But we are in a super complicated global economy. We've got a polarizing president in the US as well. And so any comment or any change in global markets could quickly impact our mortgage environment.
For sure. I think that's, if the outlooks are what we've seen, is that I think that will be refreshing for a lot of first-time homebuyers. That we saw last year, it was a lot of, the next interest rate announcement, right? That deferred a lot of decisions. I feel like a more stable environment will be able to allow people to make informed decisions on a more predictable timeline, right? Which will be, I think, refreshing, frankly.
I'd say the more stable the rates are too, the easier it is to plan, because the metrics that we outlined today, if they're still the metrics in 9 months, it gives confidence to the consumer, to the buyer,
For sure.
that their planning is adequate and they were right about it.
For sure. No, and I think that, from where we're looking in terms of our outlook for the year, in terms of clients that have reached out and we forecast to be helping this year, a lot of it is first-time homebuyers, and that's a lot of what it's a common word, peace of mind, right? Peace of mind and certainty in terms of what their next decision will be, right? So
Yeah, for sure. I think it's important to add that for many borrowers or buyers, like if they speak to us now and they don't quite qualify, and we do all the best planning and we realize they're just not going to qualify in the near future, I want to point out that these days there's a trend for multi-generational housing,
Right.
right? So kids living with mom and dad in a slightly bigger home. We are seeing that trend. Like it's very apparent in our
Oh, for sure.
applications.
Absolutely.
Beyond just using it as a cosign, it's really the whole family living
Larger
together.
home and everybody's living together. Absolutely.
Yeah, and I think that's, I don't think it's always been the norm, especially in Ottawa, because a lot of our real estate isn't built for that.
Right.
But we're seeing builders now.
Builders shift to that, actually. Yeah,
Exactly, right? And I'd say that with the influx of new Canadians that we've seen over the last few years, it is a trend that they're kind of bringing into our market, and I think it's a lovely addition.
Yeah, I mean, you see it in other markets. You see it in Vancouver. You see it in, perhaps the outskirts of Toronto, depending on the suburb of like, it's exactly what you're saying, multi-gen, the parents and the kids and what have you. So I think we've seen builders shift to it. They're adding that product line of maybe it's that main floor office that's also a bedroom with a full bath, that dynamic, which it's interesting. 5 years ago, that was not even on their agenda, right?
Yeah, it's a cool shift. I think it's a great thing for the consumer, and we can see that the city of Ottawa is pushing for density, and I think overall for the average Canadian, the average person living in Ottawa, it's a great opportunity.
For sure. Cool. Thanks for your time.
Yeah, thank you.
Awesome. Thanks so much for tuning in to the interview with Chris Allard, one of the top mortgage advisors here in Canada. If you have any questions, reach out directly and we're happy to help.